talk for a little bit because I will check the volume. Okay.
Okay, it's 6:15, and it's time for today's tax talk with attorney Stephen Leahy. Today we're going to talk about cryptocurrency and some tax advantages of cryptocurrency. I know everything's been talking about not having any tax advantages. It's been a bad thing, but there are some tax advantages. We're going to talk a little bit about that. A couple of weeks ago, maybe last week, we talked about the lost sale rule and how this works now with cryptocurrency. So that's what we're going to talk about today. So we're going to start the show.
You're saying we.
Oh, I forgot to introduce my co-host.
That's all right.
My nephew, my very good friend, Jim Leahy.
That's because I'm wearing Golden Girls.
You are.
Sure.
Love that. But let's do the start of the show. Let's do the start of the show, as I said.
It's a really nice film. Maybe more pictures like that. You don't like it? Oh, Joe said it's too long. Who's Joe? What's his podcast? What's his show?
Lower this down. See that? I got to remember how to do that. There's always something to remember, Jim. Always something to remember. And I don't always do that. So anyway.
Who does, though, Attorney Stephen Leahy?
Well, that's why some people have a team to remember this.
It's true.
Like did that just go through? I don't know. I'm not sure if that even went on the air. But we'll see. Not sure. Anyway, that's either here nor there.
Let us focus on today's tax talk, Tay-Tray, as we say on the streets.
Well, let me pull Jimmy up here.
Tay-Tray, as we say.
We could talk to Jimmy. Hey, Jim.
Hey, everybody. How are you? Remember, Open Tax Advocates is there for you when you're making an important decision such as fighting the IRS. 312-664-6649. They're coming. They're coming.
Well, I agree. So that's what, I remember, Jim, a couple of weeks ago we were talking about the loss rule. I had a client who had come to see me, and he was a day trader. So Who
isn't a day trader?
He was brand new at it, and he was trading up to $2 million over the years. And when he got his bill at the end of the year, he's like, he saw all of the gains. He's like, I didn't make this much money. Well, what he didn't know was that there was a rule about the wash sale rule. And so let's talk a little bit about that, because this is what's going to work into the cryptocurrency advantage. Okay. And we keep hearing that there aren't that many advantages.
You got it up on the screen.
Yes, here it is. So the wash sale rule is an Internal Revenue Service regulation that prevents a taxpayer from taking a tax deduction for a security sold in a wash sale. The rule defines a wash sale as one that occurs when an individual sells or trades a security at a loss and, within 30 days before or after the sale, buys a substantially identical stock or security or acquires a contract or option to do so. A wash sale also results if an individual sells a security and the individual's spouse or a company controlled by the individual buys a substantially equivalent security. Okay.
I think 30 days is a little aggressive.
Well, they say before or after, right? So that's where it does get complicated about why that is, right? So why is that? And the wash sale rule is designed to prevent people from selling securities and taking a loss strictly for tax purposes and then buying the security back. So now I get the loss on my tax return, plus I still own the stock, right? So here's the difference, right? And we've talked about this, about what's the difference between crypto and stocks. Right, because now we know, because we've been talking about it here for the last couple of weeks. Crypto isn't stock. Crypto is property. So property is different than stock. It's treated differently. There's a loophole here that you can drive a truck through, maybe, about crypto, and especially
I like how you say maybe, because like anything in tax law,
it depends.
It depends.
But and again, remember, this isn't tax advice, and it's not financial advice. We're just talking about information. I'm just telling you what's out there, right? So there's a story.
You're just pretty much talking about the statute, the way everything is explained, right? Because that's what your job is to help inform.
So again, this isn't about tax advice or financial advice. It's about giving you information. Okay, and so now let's talk about the tax loophole. Okay, and we've talked about crypto. We know that crypto is property. Crypto is not a stock. Okay, so when you buy and sell it, every time you buy and sell it, it's a tax consequence, right? Even if you buy something with it or someone gives it to you for income, then it's income tax. If you sell it, then it might be a capital gain or a capital loss. So I found a story from Forbes from last year. And so let's talk about this story.
Is this a story? So this was from last year. This was 1 year ago.
This is February 2020 when things were going up.
Good.
Okay,
when things were good.
Yes, and it's been a year now.
It's actually not too bad.
So let's talk about this story. Okay, so now,
remember, everybody, Open Tax Advocates is there for you at 312-664-6649. If you were looking for any tips on how to solve your IRS problems,
that's right.
I don't know if you know this, but Attorney Stephen Leahy wrote a book called "Solve Your
Deal with your IRS problem today."
Well, eventually you'll solve it.
That's right.
If you deal with your IRS problem.
So let me talk about this.
FreeIRSbook.com.
Tax loopholes are interesting gaps in the IRS code, which you can use to reduce your taxes legally. This post discusses an important crypto tax loophole, which could significantly reduce your crypto tax bill. Cryptocurrency trading has one major tax benefit that traditional stock trading does not offer unless you are a full-time trader. Since cryptocurrencies are treated as property, wash sales rules, which is applicable to stocks, are not applicable to crypto. Not having to follow wash sales rule is extremely beneficial for tax purposes, especially during times where your position has gone down in value. Okay, so I can give you an example, but I think there's an example in this article. So a wash sale occurs when you sell a property, sell a security and at a loss, and then purchase that same security or substantially identical. Now we just went through the
that's cocked.
So I'm going to skip that. I'm going to skip that. Okay. Assume Sarah buys 10,000 worth of company A stocks, 1,000 shares at $10 each, on January 10th. And on January 15th, Company A stock is trading at a much lower price at $6. If Sarah were to sell her position and buy another 1,000 shares at $6 per share, she would not be able to claim the capital loss of $4,000 due to the wash sale rule.
I like how they do the equation right there where they could have easily just calculated that. It's like, you lost $4,000. You had to overcomplicate everything.
Therefore, $4,000 loss is disallowed under the wash sale rule. And this is what happened to my client, right? He thought he had some losses. And so at the end of the year, he's adding his gains and subtracting his losses. And he came up with a different number than his brokerage did, right? When they sent him that, he's like, this isn't right. And the answer was, it was right. Yes, Jim.
So there needs to be some more digging because, yes, this is a year ago and we're all learning about this. Now, we're all talking about this now on today's Tax Talk Tay Tray. Mm-hmm. But we need to kind of understand, if you are a Robinhood investor, do you own this property or is it treated as a stock because there's a holding company that's holding onto this asset in your name?
I believe it's still property. It's not. It doesn't change the character of the. I don't know about. We've talked about Robinhood before, and whether you actually own the equity or the property behind what you're buying and selling, or whether you just it's fictitious. but I don't think it changes the nature of that property. That's something we can look for. Take a note on that, Jim.
I will take a note. And remember, ladies and gentlemen, if you have any questions for Attorney Stephen Leahy, you can ask away.
In contrast, now here's the cryptocurrency. In contrast, trading cryptocurrencies, which act like stocks, but under the tax treatment of property, generated a much better tax benefit. Let's say instead of buying company A stocks on January 10th, Sarah buys one Bitcoin at $10,000. Like you could buy Bitcoin you could have last year. On January 15th.
Who said that? What is this?
I'm just laughing because he says that buy one Bitcoin for $10,000.
Somebody call Forbes. Yeah, I think even then it wasn't.
This was last year, though. This was 2020.
I'm pretty sure 2020 this time it wasn't $10,000.
It was the
sure it was
whatever.
15,
He's giving an example. Okay. On January 15th, this person goes down. The price of Bitcoin goes down to $7,000. At this point, what she could do is sell the Bitcoin for $7,000, harness the $3,000 worth of tax losses, and buy back another Bitcoin to maintain her position. $3,000 loss would be allowed on your tax return as a capital loss because the Bitcoin is not subject to the wash sale rules like stocks. So right there, that is such a benefit right there. So now there's $3,000 loss that you wouldn't otherwise be able to take. It's huge.
That's absolutely huge. I would have sold a long time ago.
So maybe we could, if you have a mixed portfolio or a diversified portfolio,
write this down,
which most people should have. And again, I'm going to say we're not giving tax advice or investment advice, just information. But let's say that
that's an opinion, sir.
But maybe if you have a diversified portfolio and you have stocks that are up and you want to sell them, maybe now's the time to sell them, and then then you could sell your Bitcoin and then buy them right back. Now you get the loss to wash off the profit. That's how that would work.
That's maybe that's how that works.
Maybe.
Right? Like anything.
That's for information. Information. Again, not advice, just an observation. Okay? We're doing hypothetically. This is the way the law works.
Jim buys Bitcoin for $500.
I love this. Here's a disclaimer here. This post is for informational only and is not intended as tax advice. For tax advice, please consult a tax professional.
Open Tax Advocates at 312-664-6649.
And then I can give you tax advice. But right now, I'm just giving you information. So, but anyway, I wanted to put that out there. I thought it was interesting because we have two things merging, right? We've been talking about crypto, and then we talked about the wash sale rule last week, maybe it was 2 weeks ago. And so I thought it was interesting how these came together and how it could be a beneficial. You keep hearing about crypto and there's no tax benefits, but here's a tax benefit. It gets complicated, but it's a very good. And one thing about complications, that's what's so great about the law. Complications often produce opportunity, right? That's because if you understand the complications and you can find a way to take advantage of those complications, that's called a tax loophole. That's what's going on. So I just think it was an interesting way to come together.
So I brought this story to your attention.
You did. Did I not mention
my experience is by the time I'm getting into the loopholes, the cat's out of the bag. Right? Like it might be too late. So again, always before you do any sort of tax related move or any questions you have, you got to call a professional. And
people jump into this stuff without really understanding it. Okay. As I said about my client who was buying and selling buying and selling stocks without understanding these rules. Okay. And he got caught. And when you get caught, it costs you money. Right. And nobody wants to hire someone for advice. Okay. Because advice generally costs money. And nobody wants to do
allegedly.
That. But what really happens is you avoid these pitfalls and then it just looks like you spent money on legal services or tax advice when in fact you've saved money in the long run. And it just makes sense. Okay. That's where I'm going to go with this. I think it just makes sense.
Well, Attorney Stephen Leahy, Thanks for the information. This is what's great about today's Tax Talk, is that this podcast helps you, the listener, with all your tax-related questions. Again, there's a lot of high-topic situations that you need to know.
Yes.
And if you're jumping into, Stephen, like you just said, if you're jumping into this with not knowing, because let's face it, right? Let me give you a little story. James gets involved in GameStop because money was good. I'm not talking about me, but we don't understand any of the implications. James doesn't understand what being a bag holder means.
Holding the bag?
Doesn't get it until it happens to him.
Well, here's the one rule that all of us should understand. Okay, when 95% of the people are doing one thing, you probably shouldn't do that thing, because 95% of the people are usually wrong. Okay? And it's just, and you can go back in history and you find this out. Okay, so and you can always say, never put all your eggs in one basket. I mean,
thank God for the hatchery.
And it's easy to say that. Okay, especially when you looked around and you see all these cryptocurrency millionaires, people who bought it, less than a penny, and now it's worth 60,000, and they're millionaires. And it seems, wow, I need to get in on this. They just made. It's probably too late again. When 95, someone told me a story. They said and I forget who it was. I would like to give them credit, but I can't remember who it was. But they said in 1999.
Like it's 1999.
When he went into a strip club and the stripper was telling him that she was long on the internet stocks, okay, he said, I knew it was time to get out. And I had to say, I bet you if you went into a strip club now, I do not frequent strip clubs, but if I did and I asked a stripper, she would say, oh, I'm into cryptocurrency. Then you kind of know everybody's in. It's time to get out. You shouldn't be, because that's just the way things work. Okay. Oh, no, it wasn't. She wasn't into internet stocks. She owned like 10 condos. Okay. That's what it was.
From the movie The Big Short.
No, I never saw The Big Short, so I'm not sure.
That's literally seen in The Big Short, though, where he's like, because he's asking around, and one of them, because he asked. He asked a bunch of.
Maybe somebody was telling me this from.
I think I told you that last.
Because I lived. I gotta be honest with you. I lived The Big Short. I helped a lot of people in that year, in that time, with foreclosures and all that.
What is his name? The guy from The Office, Steve
Carell.
Is that him?
I don't know.
Anyway, he's going around trying to figure out. Like,
is he in that movie?
He starts talking. Yeah, he talks to a bunch of mortgage brokers, and I've only seen parts of it. I haven't watched the whole show, but now I'm going to have to watch it. I think you should watch it too. And he goes around, he starts talking to them, and they're all bragging. It's like, yeah, man, you know what my bag is I really like going after strippers because they got a ton of cash, and I just get them signed up for mortgages. Well, then he goes to the strip club, and he's sitting there, and goes, oh, yeah, thank you. And she starts like, hey, honey, how are you? He goes, well, how many homes do you own? She goes, 6. He's like, how many? What? She goes, yeah, I own 6 homes. It's like,
yeah.
We're in trouble.
We're in trouble. Again, and then of course that's part of the bubble is about to burst, and that's generally what happens.
Well, right? I think crypto again. What do I know? Crypto is a weird is a weird asset. It's a weird piece of property.
But it's been acting like any other bubble. Okay, properties like she just owned property, right? Condos, that's property. Wouldn't think that people are going out. But that's what the big craze was, right? And that's what happened. Again, I had clients, and again, I had a lot of clients who were buying the condos, especially here in Chicago. They were buying them before the construction, pre-construction sales, and they were buying them up like crazy because then they would build it. The price went through the roof by the time the project was completed. They sold right at the beginning, and they made tons of money. The problem was, at the end, they got caught. And a lot of these properties never got built, and they had already given a lot of money. And so there's.
I think the advice is.
I fought with many of the builders to get their money back, and sometimes we did, and sometimes we didn't. A lot of the builders went under. Then
you could write a book.
Then when the builders go under, there's really nothing you can do about that.
You could write a horror story book, or like a bibliography of like what you've done.
Well,
a bibliography is not what it is. I'm sorry.
I
see how good I am.
Yes. So anyway, that's all for today. That's all I wanted to talk about today, and we'll see you tomorrow for today's tax talk. See what that is? That's today's tax talk tomorrow.
That's
we're going to do
today.
That. No, tomorrow.
Start thinking about tomorrow today.
That's right. But we'll talk about today's tax talk tomorrow. That's why we call it T3. T3 tomorrow. Tomorrow. Okay. Thanks so much for joining us.
Thanks, everybody. Remember, Open Tax Advocates is there for
tomorrow at 6.
all you listeners out there, I got to tell you, which we have. Okay, let's turn it on. See, when I was in broadcasting, when I was in newscasting, we had to continue looking. We had a production, so keep looking. All right, 3, 2, 1, we're done. Keep looking at the screen. Keep going.
Okay, so sorry about that. We'll do it again.